We will get the latest read on Canada's inflation picture tomorrow, and economists on average are expecting a cool down. Could influence the direction of interest rates heading into next year because a cooling economy is already a consideration for rate cuts. We're going to hear more about the overall economic picture when the federal Liberals provide their updated fiscal and economic projections tomorrow afternoon. And for a preview of what to expect, we're joined by Andrew Kelvin. He's head of Canadian Global Rates Strategy at TD Securities. Andrew, it's great to see you.
Thanks for having me.
If the federal government were to paint a picture of the economy, what would be an accurate depiction from your vantage point?
An accurate depiction would be an economy that is slowing under very tight monetary policy, an economy in which households are feeling the pinch of high living costs. And it's an economy which they probably can't do a whole heck of a lot to turn the tide of, to be perfectly honest with you.
And the government itself also dealing with the fact that higher interest rates, which are playing a role in cooling the economy, are raising their own costs. So they'll obviously have to address the fiscal challenges that come with higher debt payment costs as well.
Absolutely. It's death by a million cuts. The high interest payments that they're now paying does sort of incrementally decrease their ability to add stimulus to help people who are maybe feeling the pinch from the high living costs. And at the same time, the reason interest rates are high is because governments worldwide probably had too expansive fiscal policy during the latter pandemic period because monetary policy was too loose. And in an environment where one of your chief problems facing the economy is very tight monetary policy, spending a lot more money if you're the federal government just causes central banks to keep rates at high levels for longer periods of time. So it's a bit of a tricky one for them to find their way out of.
Yeah. Do you think at some point there will be a broader conversation? I mean, governments, or I guess politics will be politics, doesn't matter what country we're talking about, but I'm sure we'll hear a lot about affordability tomorrow. But you seem to be implying that all the spending we saw from governments over the last few years complicated the affordability story. At what point does the narrative allow for governments to say we actually have to have a little bit more fiscal prudence to get back to something like affordability?
I think we're at that point in trying to generate price stability. Governments the world over can help by reining back a little bit on spending, by not adding more fuel to the fire, as it were. I don't want to sit here and criticize governments for spending large amounts of money in 2020 and 2021 because it was particularly 2020. It was a very uncertain time. The economy was in a very tough way. I think they can be forgiven for doing too much rather than too little. But I think going forward, certainly the best way of returning to a sort of more normal economy, more normal interest rates, more normal inflation would be a fiscally prudent budget from whatever government you want to talk to.
Now, I think in the markets, people are very curious about inflation and interest rates specifically. And do you anticipate the inflation story showing more signs of cooling?
We do think it'll show some signs of cooling. I do think the rate hikes that we have seen from the BOC thus far are starting to work. We've seen some pretty poor Canadian growth figures for Q2 and now looks like for Q3. That tends to generate a little bit slower inflation. When we get to the upcoming inflation print, there's a big base effect that will be coming out of it. So we'll see quite a large drop in headline year-over-year inflation from 3.8 to, we think, 3.1%. It probably pops back a little bit in December, but the sort of underlying trends do show some progress. They do show some slowing. So we're not out of the woods yet, but we do think that the upcoming inflation prints will be maybe a little bit less depressing to look at than some of the previous ones.
And then at what point, let's say, shifting to the central bank, at what point does the Bank of Canada look at the outlook for the Canadian economy, perhaps more signs of cooling, we'll see what happens there, coupled with possible signs of cooling inflation, and decide to perhaps make a change in interest rate policy?
I still think that's the 2024 story. I think that is a middle of 2024 story. The Bank of Canada, after having missed their inflation target for several years now, the absolute last thing they want to do is cut rates prematurely. That would, I think, deal a pretty material blow to their credibility and impact sort of longer-term inflation expectations, which is the one thing they're really trying to avoid here. I do think they're done lifting rates for people who are sort of suffering under high rates. That's the good news, is I do believe that they're probably done with hikes. But we're going to hear from Governor Macklem later this week. He's probably going to be talking tough on inflation. He has every incentive to sound as committed as possible to bringing inflation back to the 2% target. So I do think when we talk about rate cuts, well, you always have to take central bank communications with a grain of salt. They can change direction very, very quickly. I still think we're a long ways from talking about rate cuts as something that's near term for the Canadian economy.
And speaking of avoidance, can Canada avoid a recession?
I mean, if you look at the most recent GDP figures from Statistics Canada, they would suggest that we are in a technical recession already if we define that as sort of 2 negative quarters in a row. Like, we may well have come out of a recession already. I do think we can avoid one down the road in Canada. Recessions are a rate of change thing, and we are coming from an overheated economy to one that is now more balanced. So I'm not especially worried about 2 essentially quarters of zero growth. Going forward, it will be more difficult, but if there's one thing that could keep Canada out of recession in 2024, I would just point to the population growth. That is a fairly powerful demand driver.
And then finally, anything that could come out of the fiscal update that would really get Bay Street's attention? What are you going to be watching for?
We'll be watching, as always, for the updates on bond issuance. They have been increasing just sort of very modestly their issuance of Government of Canada bonds in recent months. We'll be interested to see if there's any continuation there. We're interested in the future of the Canada Mortgage Bond Program, which is something that they can probably tie to their whole housing affordability push. We do expect that that program will be maintained at its current size, but we'll be really looking for anything that would indicate a large fiscal expansion, which we don't expect, just because that is going to have implications for bond issuance and therefore interest rates.